Welcome to the source of commercial real estate, where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek, and today I am talking with Stephanie Rodriguez with Colliers. As National Director of Industrial Services for the U.S., Stephanie focuses on the overall growth of Colliers' industrial business, including the establishment of new client relationships and expansion of existing affiliations, as well as promoting talent recruitment and retention. With 25 years of commercial real estate experience, Stephanie leads Colliers' industrial platform, especially in providing thought leadership, research, and marketing. She brings extensive experience in acquisitions, lease transactions and negotiations, asset management, and development projects. Before joining Colliers, Stephanie was the regional senior vice president at Duke Realty Corporation, overseeing leasing for a multi-million square foot portfolio in Central and South Florida. Prior to her time at Duke, she held progressively more senior roles at Trammell Crow Company and CBRE. Stephanie has loads of experience in industrial commercial real estate, and I am thrilled to have her with me today. Stephanie, how are you doing today?
I'm doing great. Thank you for having me, Jonathan.
Of course. Sincerely looking forward to this conversation. You have a really impressive background, but from your perspective, why don't we get a little bit more about your background, how you got into commercial real estate, and what you spend your time doing now?
Sure. We can start from the beginning, which, you said 25 years ago. I think we're going on 26 already, and that makes me feel very old. But I think, like a lot of people from my age demographic, we didn't know what commercial real estate really was. I graduated from college with 2 liberal arts degrees and had zero idea what I wanted to be when I grew up. So I stumbled into a role working for a REIT that was located in Washington, D.C. And I was, 23 or 24 years old at the time, and really had no idea, what was involved in the day-to-day in that space. So I started in an entry-level role and progressively worked my way up through the operations side of the business. So property management, maintenance, facility management type work. And ultimately, halfway into my career, switched over to the transaction side of the business. So that's when I went into leasing. I was at Duke Realty at the time, and I had no idea what I was doing. I was flying blind. I had never had a sales type role, but after a couple of years of struggle trying to get my feet under me, I started having a lot of fun with it. So when I was at Duke, I was in that leasing role, eventually transitioned into the development side of the business there, and then ultimately ended that portion of my career overseeing our Florida market for the company. And that included everything from, acquiring sites for development, putting those development projects in place, and then ultimately leasing them. We owned and managed those assets long term. So it was really fun for me to experience that full life cycle of the projects. And eventually, about a year ago, Prologis decided that they wanted to purchase Duke, and that merger happened. And I took it as an opportunity to sort of make a pivot. And that brings us to where I am today, which is at Colliers. I was once a client of Colliers, so it was an organization that was familiar to me to a certain degree. But they were looking for someone to lead the industrial service line, which is its strongest service line within the company. And it's fantastic. I love what I do. I wake up every morning excited to go to work and kind of deploy any knowledge and experience that I have accumulated over my career to our clients, and also the almost 700 brokers that I partner with on a daily basis. So that's sort of the progression and where I am today.
So as National Director of Industrial Services at Colliers, you probably have kind of a bird's eye view, or like a 30,000 foot view of what's happening in the industrial market. And I don't expect you to be an expert in the nationwide industrial market. But from your perspective, can you give us a 30,000 foot view? What are you experiencing in the industrial space right now?
Yeah. I mean, they sort of pay me to have some sense of what goes on all over the country. Even though I sit in South Florida, I'm on airplanes quite a bit. So I'm meeting with our clients, and those are both owner investor clients and occupiers of industrial space. And I spend a lot of time with our brokers. And I hear a lot about what's going on. We produce a lot of research as a company in this sector. So, just in general, I would say where we are today, deal velocity has slowed a bit. It's still strong. If you compare where we are today to where we were in 2019 before the big industrial boom started happening post pandemic, we're really just right on par with that. And those were great times. So, there was no complaining coming from the brokers. We got very comfortable with, such a buffet feast in front of us for the last couple of years. So there has been a slowdown compared to that, but we're still sitting in a good place. Tenants are being much more analytical and not so willing to take as much risk as they were. So prior to, this part of 2023, space was being gobbled up faster than it was being built. And that is not the case anymore. Where we used to have 5 to 10 prospects looking at a space in any given market, we might be down to 2, maybe 3. So demand is not quite as strong, but there's still demand. We're seeing a little bit of a slowdown in the big box space, which is 200,000 square feet and higher as far as size goes. But a lot of that, the numbers on paper are a little misleading, only because a tremendous amount of space is hitting the market right now with development completing on projects that were started prior to interest rates starting to pop. So there's an influx in available space coming to the market now, fewer tenants looking or taking it down. So it looks like there's a bit of a disconnect, but I have confidence that we'll absorb that space ultimately as we go into next year.
Let's define our terms and exactly what we're talking about. So, industrial is such a wide term. It can range from the big box, which you referenced, 200,000 square feet and above. Industrial can also be, multi-tenant, Class B, 2,500 square foot little units. It can be 10,000 square foot single tenant, flex space. So when you're talking about industrial, are you referring to more of the big box stuff, or is it really the whole gamut?
We put a lot of focus on the bigger product. So the smaller flex type space is the vacancy is a little bit lower there, just because small businesses need that space. Rental rates in that space, that portion of the industrial space, are very high right now, just because nobody's building it and there's still a need. So because nobody's building it, which is another sort of recent phenomenon, just due to interest rates, nobody's buying land. There's a lot of cost associated with building those smaller bay projects. The rental rates continue to climb very aggressively in the flex space. So when we focus on industrial, it's predominantly larger footprint, larger box facilities, and but from all quality levels. So it could be brand new product to buildings that were built in the 70s for manufacturing purposes.
You touched on a couple things when you were giving us your overview. So it seems like there's been a shift maybe in the last year. You mentioned tenants being more analytical and being more thoughtful before they sign a lease for a space or to expand their space. And you also mentioned that, there may have been previously 10 or 12 potential occupiers looking at a space, and now that's down to 1 or 2. Is that change simply a result of increased supply, or can you pick up on any other possible reasons for that change?
I think increased supply certainly has something to do with it. People have more options now, and there's so much economic uncertainty that I think most occupiers are just a little more cautious because they're not sure what's going to happen with their business. Is there a recession looming? Is there not a recession? I mean, we've been talking about that for 2 years now. So I think that plays into it as well. I also think that there was such a mad dash to take any available space in 2021 and 22 earlier in the year that tenants are now taking this moment to pause and reflect and really focus more on data analytics and space optimization. They were taking down warehouses and just filling them with rapid fire because of the shift in supply chain needs. And now that they have a moment to sort of catch their breath, they want to make sure they're making good decisions. So are we utilizing the footprints that we already have, in place? Are we underserved in a certain market that we need to prioritize and focus on first? So I think they're just really almost level setting their real estate needs at this point in time.
So you started kind of alluding to some of the factors that tenants are thinking about. When you're working with tenants and prospective occupiers, and your brokers are working with prospective tenants, what are some of the top factors that tenants are considering when they're looking at a potential site?
Yeah. There's been a lot of chatter lately about infrastructure and utilities coming to buildings, and there are a number of things fueling that. So I think people are paying much more attention than they used to power and water capabilities in a facility. And that's not just for manufacturing uses. So California recently put into place some legislation that requires fleets to be EV by a certain date. Because of that, developers and tenants alike have to think about, is there going to be adequate power for me to charge all of these vehicles long term? So I think power is now taking precedence over a lot of other factors that used to drive location identification for a project. Labor is another big one. What kind of labor do you need? Is it skilled labor? Is it unskilled labor? How close are they to the potential facility? Because nobody wants to spend hours in their car before and after a long day at work. So labor is a big factor that people are considering now. Highway access and access to ports, airports, things like that are still very important. But, a lot of that real estate's already gobbled up, especially in some of the more land constrained markets. So we're seeing a little bit of a shift in that site selection strategy than we were, say, 10 years ago.
How are you advising tenants right now, and how is that different from the years we were talking about previously, 2020 through early 2022, when investors and tenants were just trying to gobble up anything they could? And amidst the shift that we've seen in the last 12 to 18 months, how are you advising tenants in terms of timing, in terms of pricing, being patient, and finding exactly what they want and need?
We always advise our tenants to get out in front of things as soon as they can. So the more time you give yourself, the better, because it's never enough time in the end. I mean, it really, truly isn't. So we try to get out in front of requirements and needs early by making sure that we are having a lot of conversations about what the long-term strategy is for growth for that tenant. So giving ourselves ample cushion is very important, especially when it comes to the smaller spaces. More often than not, tenants who lease smaller spaces, they wait till the last minute and, oh my gosh, my lease is expiring, or I need another 25,000 square foot space. Those spaces are now very hard to come by because of that evolution to the more big box development that we saw in the last few years. So giving yourself as much time as possible is critical. As far as rental rates go, we continue to see rental rates grow. Prologis, who is one of the largest clients that we work with on a developer owner side, they are the world's largest industrial owner. They are very bullish on continued rent growth, and they typically set that market because they are so sizable. So rental rates continue to grow, even with an increased vacancy rate nationally, and we're advising our clients to that. But we're also advising them that because of this influx of available space that we're seeing now, with all of these new deliveries coming online, we're seeing some more concessions being offered. Rental rates are still held high, but people are starting to be more willing to talk about free rent, to talk about, tenant improvement packages where they can offer them, and other concessions that might be important to sort of offset those rental rate costs.
What are some of the biggest challenges that prospective tenants are facing right now as they're considering new space and looking for new space?
I think number one is still sticker shock. I think rental rates have climbed so tremendously the last couple of years. And if they haven't looked at space in a while, maybe they renewed their last lease, 5 to 10 years ago, somewhere in that. It's almost like we need to start a support group. And that's where the brokers have to be counselors as well, not just real estate advisors, because they haven't seen prices like that. And they're shocked when you're telling them that their rent's doubling. And, and then their pass-through expenses are also climbing because insurance is really, really very costly. Real estate taxes continue to climb. And then variable costs, we're in an inflationary environment and those continue to rise as well. So sticker shock is still, I would say, the number one challenge, the biggest thing that tenants have to wrap their heads around on a daily basis.
You just mentioned insurance, and I want to ask you about taxes and insurance. I have a lot of empathy for tenants as, in these triple net leases when these expenses are passed on. And the tenants are, in most leases that I see, are virtually powerless to fight it. You mentioned insurance, particularly in places like Florida and other places that are susceptible to natural disasters. Taxes, when properties get reassessed, notably in places like Texas, where there can just be this massive increase in those two items. Do you ever see any anything in leases to protect tenants, or are you seeing any tenants get a little savvier in trying to protect themselves on, being hit with these massive increases in CAM charges over the length of the lease?
Well, I mean, there are two different, I guess, discussion points I can make on that subject. Pass-through expenses are truly just that. It's the cost that the landlord is paying, and those expenses are passed through to there's no upcharge. It's in the landlord's best interest to maintain low CAM expenses for their clients, because it does them no good if their CAM charges are just as high as the rent. Ultimately, they'd like to charge more for the rent because the pass-through is just making them whole. So, and that's me putting on my former landlord hat, Typically, we see almost every single sophisticated institutional owner appealing their taxes annually when they can. They're working with third-party consultants to mitigate those increases as best they can. So they're, sometimes successful in fighting appeals if they're being unfairly assessed. If the building is vacant and the income stream is lower, different things like that. So landlords are also fighting those increased costs. Insurance, unfortunately, feels unavoidable. I mean, it's just the cost of doing business, the cost of owning real estate. It's all just, it's a sunk cost, basically. And until you need it, it's very painful. Florida, I live in Florida. I used to oversee the Florida market, and just the global disasters that we've been seeing over the years continue to cause so much loss for the insurance companies that it's just a continued battle for everyone involved. One thing that Prologis has done, and I feel like I'm talking a lot about Prologis today, but they do sort of lead the charge in the space. They implemented their Clear Lease a number of years ago, and that Clear Lease includes, it's a fixed cost for all of those pass-through expenses. So they have done their own analytics to determine what, through the life cycle of that lease, those pass-through expenses are going to look like, and they bake that into their rents. And so from the very beginning what those expenses are going to look like. And it sort of takes the guesswork out of it, the variability that comes with it. And I think that's really beneficial for especially a lot of the smaller occupiers who just can't afford to get hit with big true ups on an annual basis. So it's been a successful program for them so far. They seem to have it working very seamlessly from an outside perspective looking in. And, tenants seem to be embracing it. So that's one way that we've seen somebody sort of trying to solve for that variability.
I really like that creative thinking, and because I'm an owner and investor myself, but I do want to empathize with my tenants. I'm all for pass-through expenses, but on the other hand, as I interview people on this podcast and I ask them about raising rents, and they say, yes, rents are increasing, but ultimately we can only charge what a tenant is able to pay. And so it doesn't do any good to get a tenant into some lease, doubling their rent and then having insurance increase 50% and having taxes increase 50% and having this giant building with a tenant that is struggling financially. That's not good for anyone. And so I really like this, the Clear Lease that you mentioned from Prologis. And I certainly don't have any answers, but I would rather have, a lease structure that is fair to everyone involved, that the tenant can pay, rather than, charge them crazy amounts and have them struggling and ending up, struggling to pay that rent or leaving at the end of the lease or before the end of the lease. That's my perspective.
Yeah. No, and again, that's why reviewing financial information for your tenants is so important, to make sure that they're not biting off more than they can handle. So,
sure.
Yeah.
I think that's this discussion is a good transition to some buzzwords that we've been hearing over the last few years: onshoring, reshoring. This idea of the U.S., we've been getting a lot of our goods from overseas. The pandemic really highlighted some of the weaknesses in that strategy. And so now there's a trend to bring a lot of that manufacturing back to North America, either in the United States and Canada or even in Mexico. So I just wanted to ask you if you had any thoughts on any trends or patterns that you're seeing emerge from this onshoring and reshoring idea.
Yeah, we are seeing it. It is real, but I will say it takes time. So just like those jobs didn't go away from the US or Mexico or Canada overnight, they're not going to come back overnight. Those industries aren't going to just suddenly appear and plant their flags in the US. But we are seeing some shifts in that space. We've done a lot of blog posts on our website that dig deeper into the concept of nearshoring and onshoring. Mexico has been a huge beneficiary of the onshoring. Labor is still much cheaper there. And the close proximity to the US helps mitigate some of the supply chain issues that we've been experiencing since the pandemic. Geopolitical unrest certainly is a factor. Previously, a lot of decision makers for manufacturing companies weren't even contemplating it. since the pandemic, over 90% are now creating a plan for either onshoring or nearshoring all or part of their operations. So that we're not so heavily reliant on Asia, and other countries for those goods to be brought to the U.S. So a lot of legislation was passed under the Biden administration, like the Inflation Reduction Act, the CHIPS Act. We're seeing a very big uptick in anything green energy related coming back to the U.S. A lot of battery manufacturing, solar panel manufacturing, and we're doing a lot of those deals, representing those tenants and finding them locations and facilities to put those operations in place here in the U.S. Mexico, we're seeing a lot of increased activity in the industrial sector in border cities, in Texas, California, where the goods are coming into the country and going into the distribution network from those places. So we're definitely seeing an increase, and it's real. The one thing to caveat that with is, again, available power and water. So those things are definitely needed. Skilled labor is another big factor there. So, we saw a lot of news about chips coming to Phoenix, and with Taiwan Semiconductor, and they've delayed their project by a year because they didn't have the local skilled labor that they needed. And they were going to import the labor, which really doesn't do the local, workforce much good. So now they're delaying that project by a year in order to hopefully ramp up that education that they need in order to employ the skilled labor there. So power, water, electricity, some of those things are really, they need to keep pace with the demand for getting those facilities up and running in the US as well.
How would you advise an investor or an owner who says, oh my gosh, there's going to be this massive demand, all this onshoring and reshoring? I want to be able to capitalize on this. You had talked about a couple ideas, making sure there's access to utilities, border towns, things like that. How are you, or how would you advise someone who wants to be opportunistic with this trend over the next decade?
Yeah, we have a number of internal consultants. I am not an expert. I fly, like you said, at 35,000 feet, and I kind of dabble in this, that, and the other, and know enough to be dangerous, but I know by no means an expert. But we have some in-house experts who do a lot of consulting work for our clients on both the occupier side and the investor side when it comes to site selection and where they should be placing their money for investment. So we have somebody who works, who leads our supply chain solutions team, Brewster Smith. He's a phenomenal resource for all things related to, if an investor is looking to build a manufacturing facility in a certain location, what might be important? Well, maybe getting raw materials to the site is important. So highway access, rail access, things like that. Brewster can cover that. Brett Swango does our workforce analytics work. He's another terrific resource because he can dial into the smallest of details what kind of labor is within close proximity to a certain area. He follows labor and workforce trends. So perhaps a large factory closes down in the Rust Belt somewhere. All of a sudden, there's an influx of available labor in that market. So is that a good opportunity for an investor to either buy that facility or to construct a new modern facility and then pull that labor into an operation? So we really take almost a scientific approach when we're advising our clients, and following the trends of where do these operators want to be, where do these manufacturers want to go, so that the investor developer can meet them where they want to be.
Yeah, makes a lot of sense. And you even dropped some names there. I'll probably reach out to those people for some of their expertise.
Yeah.
Stephanie, I want to ask you about kind of the state of the market in terms of transactions, buying and selling. If a seller comes to you or one of your brokers or an owner, a prospective seller, and they say, I'm thinking about selling this property. How would you advise them? What are some of the conversations that you all are having with sellers right now?
There are a lot of valuations happening. So, formal valuations or even broker opinion of values being drafted. I think in general, there's a bit of hesitancy to bring something out to market unless they absolutely have to sell it for one reason or another, just because it's not so easy to get loans anymore, um, especially larger sized transactions. So, the smaller deals are a little bit more palatable, more easy to digest at this point. So, having a lot of conversations about what's the value, who would your buyer pool be, how are you planning to finance this, or is this a cash, transaction? So you're having a lot of those conversations up front to set the expectation with the potential seller for what opportunities may be out there for them to take advantage of.
Are you seeing a lot of increasing cap rates, or is it more of a thing where if something is going to sell, it's going to sell at a certain price, and if it doesn't sell at this price, then it's not going to sell? Or are you seeing some price concessions on sales?
I'm not in the trenches on this one every day, but I can say cap rates, yes, have gone up. That's not helping. And in some cases, we can't really identify great cap rates because nothing's been trading or very little has been trading. Something may have traded, but it was part of a larger portfolio sale. So really, what true cap rate did that trade at? So I think that creates another layer of disconnect to the deal flow that we're experiencing. I think that good quality assets with really strong buyers continue to trade. I think some people have plenty of cash to make some opportunistic purchases, but there's still a pretty good bid ask spread in general when it comes to sale transactions.
What are some of the biggest challenges that owners and investors are facing right now?
I think that in general, it's the numbers aren't penciling very easily on new projects. I had a conversation with a good friend of mine this morning who I used to work with, who now works for a different development company. And, they continue to pursue opportunities, but they just can't get the underwriting to work because of cap rates, because of interest rates, because of construction costs. It Even if you throw the land in for free, they're not making any money on the deal. So I think that is really the biggest challenge because everybody's sort of sitting there like twiddling their thumbs, just waiting for something to happen, for things to open up again. For those who own stabilized assets, perhaps it's competition with new assets that are coming out of the ground and losing tenants who might be interested in going to a newer, more modern facility. That's probably one thing that nobody's really talking too much about. Industrial tenants tend to be a little more sticky. They don't move frequently. If they have enough space, they'll make it work because it can be a complicated process. So I think really ultimately the investor, owner, developers, the biggest struggle is trying to figure out how to make a new deal work.
Absolutely. I can attest to that for sure.
Yeah.
Stephanie, as we wrap up here, are there any, final thoughts, closing comments that you want to leave our audience with about the state of the industrial market?
I mean, I would just say in general, I think that it's still a great sector to be investing in and to be working in. Even though sales have slowed down tremendously, development projects are sort of on pause at the moment. There's still a tremendous need in the country. And I think onshoring and nearshoring will over time, we're going to see some some influence in that space, and that will then gobble up some of this new space that's delivered to the market. And tenants will continue to make sure that they're operating in an efficient manner. So they're going to evaluate any and all opportunities that are out there for them to modernize their own distribution networks. So it may be a little slower than it was the last couple of years, but it's still not a bad place to be.
Absolutely. And finally, Stephanie, if a listener wants to reach out to you, where would you like to send people?
I would say to my LinkedIn profile is always very active, and I'm on there a lot sharing, things that we're working on as a company and thought leadership pieces. So that's a great place to start. And then the Colliers website, if you head to the industrial services pages, you can get a lot of information there.
Perfect. Stephanie Rodriguez, she's with Colliers. She has almost 26 years of experience in commercial real estate. Stephanie, I've sincerely enjoyed this conversation, getting your perspective on the current state of the industrial market. Thank you so much for joining me.
Thanks so much. My pleasure.
Listeners, if you enjoyed this conversation, feel free to reach out to either one of us. We love talking about commercial real estate, and we would love to connect with you. Thank you so much for listening. You have tons of choices when you listen to podcasts, and we appreciate you listening with us today. Until next time, take care.